Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Our guest today, in fact, our topic today is how to have a less stressful portfolio in what promises to be volatile times, with Donald Trump's post on X showing the way. Our guest today, to start off the show, is Kalpen Parekh, MD and CEO of DSP Mutual Fund. Kalpen, I hope all is well. I'd love to understand, how do you think about a portfolio construct in such times?
As you rightly said, X will get a lot of attention every day now because Trump is known to announce decisions on Twitter before anything else. So I guess most market participants will constantly be looking for his comments, and I think it will be a very noisy regime for the next many years. And obviously, we can't build portfolios around noise. It's too early to say what will be the implications of what he has said, whether it is just rhetoric and posturing, or whether it will truly play out. I think generally the thesis for the last many months has been that the world will see, higher tariffs and some sort of deglobalization, which in itself could have challenges in terms of overall growth. In the last 20, 30 years, we have all been beneficiaries of an integrated world and global marketplaces available to best companies of the world. So if you're a great company, you can sell into any country without these barriers. Now, I think the language that US is talking, if it were to apply that, and other dominant countries were to match that rhetoric by counter actions, we will see increased volatility, and it'll be very difficult to create long-term forecasts. And which is why I have personally always felt that never extrapolate good news too far into the future and overpay for that good news, because the intermittent uncertainty will create significant volatility of prices in various asset classes, not just Indian equities, but any sort of equity or any sort of even bonds for that matter will have significant volatility. Currencies will have volatility. So I think a good portfolio will be built on pillars of sensible diversification and overweighting that asset class where cash flows are discounted at sensible valuation. I think that is the simple framework which generally has stood the test of time, decades before today's conversation and maybe decades after today's conversation also. So I think sticking to that core principle is how I would build a globally diversified portfolio across equities, stocks, bonds, and some bit of precious metals.
So, okay, so Kalpen, we have this message from Donald Trump and maybe many more, like you said. What is this ideal all-weather portfolio? I mean, do you buy a multi-asset fund? Do you buy a balance advantage fund, if you will, or do you individually construct some of these within a portfolio? So get in a mix of active equity funds, some debt funds, some global funds, because now people have their option of even buying global funds in a meaningful way.
Absolutely. So I think there are multiple ways to build this portfolio. You can construct on your own by buying individual slices, or you could give it to a multi-asset fund, which itself will, buy all these four asset classes. All four means Indian stocks, global stocks, Indian bonds, and some bit of precious metals or some bit of commodities. So either a fund will do it, or you can individually build that. My bias is to, do it in a fund so that even whenever rebalancing is done, that rebalancing is tax efficient. For example, 1 year back, our multi-asset fund had 20% in gold and silver. They've run up sharply in the last 1 year, almost 25 to 30% returns. Now, today the exposure is 16% because all incremental money is going more into banking stocks in India because they have not run up. So a well-managed multi-asset fund is my bias, but equally you could do it on your own. You could do a balance advantage fund along with the global fund and gold separately. That also will give you a similar outcome. Or if an asset class becomes very cheap, if equities become very cheap, you may not want to do this, but just build an equity portfolio if valuations are cheap, which they are not right now, and that is why the need to do multi-asset. Also, let me say nothing is all weather in my view. There are times we have to live through stormy weather. There will be phases when even a multi-asset portfolio will underperform. In fact, I am a bit worried right now that all four asset classes in the last 1 year have done well. Global stocks, Indian stocks, gold and silver, Indian bonds, all of them have done well together. Ideally, they should not do well together. So there could be a period where even a multi-asset fund will underperform. So as investors, we have to be open to accept that Nothing will work all the time, but generally over a medium to long period of time, these type of strategies will give you less volatile and more stable, reasonable long-term returns.
Okay. Uh, so, Kalpen, what are you? So, I know that Kalpen Parekh talks a lot about what he's done in his investing as well, right? You may have an existing portfolio, etc., which is fine. Without getting into the nuances of there, where is it that the recent set of investments have gone into? Have they gone on the global side in global funds, or have they stayed on the local side? And if they've stayed on the local side, have they been bent towards fixed income, or are they bent towards equities?
So all through last 18 months, including 20, see my date of birth is 28th July. So every 20th is my SIP. All these SIPs in the last 12 months have gone in our multi-asset fund because I do want to increase global exposure in my overall portfolio. So the multi-asset fund gives me 22% of global stocks. I do want to gradually increase gold exposure because that's around 9%. I don't mind taking it to 12, 15%. So a multi-asset is a better vehicle for me in this regime. If Indian equities were to become cheaper, then maybe I will, not incrementally add to multi-asset. I will add to an Indian equity fund. But I think Indian markets are also expensive compared to, what they deserve to be at for the type of growth rates and ROEs that we print. Similarly, global stocks are equally, compelling and also cheaper in many pockets. So I want to increase my global exposure. And I like bonds, India bonds, because for the last 18 months, we've been having this view that interest rates have, been at a high and they will trend downwards. The recent growth numbers will also add to that stimulus. So I think incrementally, all my money has been going to our multi-asset fund.
Okay. Kalpen, what's the average kind of return that a multi-asset fund can give? Part one of my question is that. Part two, in the current scenario, because I heard you say, right, that Indian equities, global equities, gold and silver and bonds all have done well. So therefore, should one temper the return expectations over the next 12 months, even if the average return in a multi-asset fund could be X, should the expectations be tempered currently?
Completely. And many times, every time I have said temporary expectations, generally the returns have been higher. So I
So
hope
maybe say that again.
even better returns. But I tell you, very long term, over a 5-10 year holding period, whenever we have held any of these asset classes on a 5 to 10 year holding periods, the median return of bonds should be around 7%, where today's interest rates are. The long-term return of gold has been around 11% in rupee terms. The long-term return of global equities or Indian equities has been in the range of 12 to 14%. If you buy them cheap, we have earned 14 to 18% CAGR, but you're not buying anything cheap today. So let's assume 12%. So the range of return will be between 7 to 12, bonds at 7, gold and silver over a long period around 10 to 11, stocks at 12 to 14. So if you average all of them in a certain mix and rebalance every 2-3 years, data has shown in the last 25 years, if Nifty has given 13% return, a multi-asset fund has given around 11 to 12% return on a 25-year basis. Or even you break it down to 3 and 5 year rolling period, it will tend to earn 1.5% lower than Nifty, but with only two-thirds of volatility. So that is how I would think about it. Marginally lower returns, but meaningfully lower volatility.
Okay, and which is also
And
actually
the last point is last
yeah,
year,
yeah.
multi funds have done 25%. A lot of people are getting excited to that 25%. Multi-asset funds are not designed for 25% return. In fact, no fund can give 25% unless you buy in a crisis like COVID or a GFC.
Yeah, yeah, yeah. So don't get excited by that. What are the risks, Kalpen, to this strategy? I mean, I heard you say that almost all of your money is gone into multi-asset funds in the last 12 months or 18 months. What are the risks to something like this? Is it a much more meager returns? And when would these risks play out? It will play out if indeed the Indian economy grows much better than anticipated and therefore earnings growth is better, or some other scenario.
See, if Indian equities do better, the 40-50% component of the portfolio will do well compared to the other 50% if Indian stocks were to do well. But I think the risk here could be if interest rates, remain high globally. Gold could slow down. Last 2 years, gold has done well also because, global yields were very low. And there was an anticipation that Fed will cut rates more aggressively after they rose in the last 18 months or so. Now, Fed made the first rate cut, but interest rates have actually risen after that. And with this new Twitter world of uncertainty, with more tariffs, etc., if the world becomes relatively more inflationary, interest rates globally could be on the higher side, which can mean that gold can underperform. Remember, like equity for 4 5 years many times gives zero returns. Even gold for 5 7 years has given zero returns. So if gold goes through a period of consolidation, multi-asset funds could underperform. Global stocks, especially US stocks, have done very well over the last decade. And 50% of global portfolios have US stocks. They are all at 25, 30 times. So you have to be very discerning which part of the global market are you allocating money. So the risk could come from global equities, expensive Indian equities. Indian equities have just seen a 10% correction on Nifty, 7 8% correction on Nifty. Small and mid caps have barely corrected. There could be risk coming from that bucket also. Except fixed income, I think all the other three components, because they are sitting at higher valuation than what they deserve to be, there could be some bit of volatility from all those three components.
Noted. Okay. Kalpen Parekh, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time and this small guidance that you've given us. Much appreciated.
Thank you.
That's the view from Kalpen Parekh. A multi-asset fund strategy is what he's going for. In fact, he said that he's done that personally as well. It may not be a bad strategy, and of course, the risks outlined there. Now, let's try and get somebody who advises multiple people on what to do in a scenario like this. Mohit Gang, co-founder and CEO of Moneyfront, with us on the show. Mohit, good having you as always. Thanks for taking the time out. The premise of this conversation, Mohit, was that there's a post that came in from Donald Trump over the weekend, right, wherein he's spoken about a tariff war, etc. So we are entering a period of volatility, a lot of unpredictable things happening, and therefore the idea was how to design a portfolio which might withstand some of these things. So Kalpen's view was that maybe go and spread out across different asset classes, because you don't know what will get hit where. I would love to know how you think about this.
Thank you very much, Neeraj, for having me on the show. And look, I kind of concur with Kalpen on one count, which is that you never know from which side you will get hit, right? So unpredictability is the mantra of the coming year ahead. And I think we have to be ready and prepared to have all fronts open. And from that perspective, from whatever Kalpen was saying, and I was hearing that having a multi-asset with a mix of all assets perhaps is an advisable allocation, or rather I'd go a step further and say that you have to have a proper asset allocation and a well diversified portfolio, because you never know what side of the coin will flip in your favor and what side will flip against you. So you have to be well prepared to face all fronts, whether be global equities, whether be commodities, whether be bonds, and be equities, right? My sense is everything will give you around moderate returns, and you have to be prepared for those cycles which will keep coming in the interim for each of these plays. So a fully diversified portfolio across these, depending on obviously the risk appetite and the profile of the investor, is the most advisable one.
Okay. So Mohit, how do you do this? I mean, if you have clients coming to you, and obviously because there is an advisor advising, so you're looking at it full time. Or let's assume there is an investor who's willing to look at it full time, and she's not shy from focusing all of her energies onto their mutual fund portfolio. Do you design a portfolio with different kind of funds catering to different asset classes? Or would you choose a good multi-asset fund or a dynamic asset allocation fund or a combination which could do this for you?
Look, though it will kind of depend on the profile of the investor, whether the person coming is a retired person or on what age bracket, what kind of risk profile and everything. Is he or she a little more active investor, more involved investor? If that be the case, then I would diversify across all segments of market cap and all investing styles, right? And so which means I would have a proper mix of separate funds in each bracket, which is a large, mid and small, with three different styles at least at the minimum. One be a momentum style, second be a value style, and third be a quality style. So three styles and three market caps, capturing a fully diversified portfolio would be my advice, rather than going into a packaged combination of having a dynamic asset allocation or a multi-asset allocation. That would be the core part of the portfolio. The second part of the portfolio will be global diversification, which predominantly would be US equities. Look, whatever said and done, US economy continues to surprise us. Even if you see last 1 month odd return, S&P and Nasdaq have all created new highs, and Russell 2000 has delivered almost 10% on return in last 1 month, right? So US market continues to surprise us on the upside, and that's where a holistic portfolio needs to have an allocation at all points in time. The third and the final frontier, which one needs to tackle, is the commodity part, which comes through a gold and silver kind of an allocation. Look, in a world which is increasingly getting more complex on the geopolitical front, you never know which side of the Pacific will explode, right? And you have to be prepared. And gold perhaps is the best possible allocation in a portfolio to be prepared for such times. Uh, Along with gold, we are also fairly bullish on silver. A portfolio combining gold and silver up to 5 to 10% allocation, I think also deserves merit in any kind of a thing. Bonds, again, it depends on the risk profile of the investor. If you are an investor who wants some safer allocation but want to play the interest rate cycle, which has started reversing in US, but because of the Trump trade has kind of the yields have kind of gone up again on the US 10-year part out there. But it's a fantastic part. It could be a great idea to play the US 10-year yield along with the Indian 10-year yield. Our view there is, from a 1 year perspective, you would see the yields easing off significantly from this level, and investors will make a good amount of money on the long end of the curve, which is the long-term bond funds also.
Noted. Okay. So, Mohit, how does one who's listening into this show right now design that? Choose a multi-asset fund, or if it's individuals, as you mentioned that there are some checks and balances can be done, but some of these funds can be taken. Are there some examples that you can share with us? They need not be an exhaustive list, they need not be an exact recommendation, but examples of funds which you believe are doing a decent work in each of these areas.
Got it. I'll go the reverse way, Neeraj. The first and foremost for people who are looking for debt allocation, I'd go with an HDFC long-term debt fund, and perhaps any other income fund or a gilt fund. That would be 10% of the portfolio for people who want to play the interest rate cycle. For commodities allocation, 5% allocation in a silver ETF fund of fund, and 5% allocation in a gold fund of fund. It could be Aditya Birla Sun Life Gold Fund, or a True ICICI Gold Fund, or a Nippon Gold Fund. And similarly for the silver part, that's 20% of your allocation. The next 10 to 15% allocation goes into global or international allocation. Out there, a NASDAQ 100 fund of fund, which could be a Motilal NASDAQ 100 fund of fund, or a Edelweiss US Technologies fund, which is a more active allocation on the US tech side, are advisable. Even DSP Global Innovation Fund is a decent choice out there. So that could be another 10 to 15% odd allocation. And the remaining portion goes into Indian equities, right? So out of the 70 left in the bucket, I would go 40 in large cap right now, which would be a Nifty 50 and a Nifty Next 50 index, and the remaining 30 into an active mid cap and an active small cap fund, which could be an Edelweiss mid cap fund or a Bandhan small cap fund. Again, these are just names which are my top of the mind recall, and we are fairly bullish, but there could be multiple other choices in all segments out there. And for someone who's wanting to look at factor or styles of investing, then perhaps a UTI Nifty 200 Momentum 30 Index Fund and a DSP Nifty Midcap 150 Quality 50 Index Funds are great choices to include in the overall portfolio mix.
Remember, viewers, as Mohit said, that this is not an exhaustive list, and maybe you should consult your advisor as well, but take the thought to your advisor if you have one, and if you don't, I think both Kalpan and Mohit have laid it out beautifully about what you could do. Maybe try and follow some of this advice. If you want a lower volatility overall experience over the course of the next 6 to 12 months. Last point, viewers, this is preemptive. We believe that there could be volatility, and therefore this is the messaging. It could well be different as well, in which case you need to change your investing style, so on and so forth, with regards to our investing components within your portfolio as well. But Mohit, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time.
My pleasure, Neeraj. Thank you.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.